Hello everyone, good evening, welcome. Welcome to our first session in our online Money Makeover series. Tonight we're talking about tax. My name's Harry Brennan, I'm a journalist at the Telegraph. I'm a senior personal finance reporter on the Money Desk. And over the next 45 minutes or so, I'll be talking to tax columnist Mike Warburton, all-round tax guru at the Telegraph. And we're going to be talking about some tips and tricks that you can use to manage your own affairs and your own tax liabilities, and sort of how to make the most of your allowances as we get towards the end of the financial year and into a new tax year. So without further ado, I'd like to welcome our guest speaker, Mike Warburton, who was tax director at Grant Thornton for many years, one of the big accountancy firms, and he was also sort of an informal advisor to a number of politicians in his time, including a younger Boris Johnson once upon a time, who gave him a call one afternoon to quiz him on his tax knowledge. And I've just seen him pop up on my screen. Mike, thanks for joining us.
Very, very nice of you to invite me. And may I say how lovely it is to see, as the names have been coming up from all over the country and indeed further afield. I saw one there from Paris, which is exciting. I saw one from Walton-on-Thames, where my daughter lives. I don't know it's the same street. So there we are, all over the place. It's great.
Okay, well, we're in good company then. I think we might as well just dive straight in, because there's lots to talk about. And we have, as I say, have had a lot of questions. The first one is about what has changed. And obviously a lot has changed this year. One reader wanted to know basically what is new. He says, are there any new tax breaks that we should know about? And he's especially interested in new tax breaks for small businesses. So anything, Mike, that comes to mind straight away?
Yeah, well, two or three things I thought would come in there. It's not a particularly big deal, but obviously with COVID coming in, a lot more people are working from home. And a year ago, when the pandemic started, the government realised that people's costs at home would go up. And as you probably know, if you're working from home as an employee, someone under PAYE, you can still claim for the additional costs of working from home. But the test is wholly exclusively and necessarily. It's basically the additional costs. But to save people the trouble for small amounts, they introduced an allowance of £6 a week, which you can claim no questions asked. And the government have, a few days ago, they announced that they're going to extend that. So it's another £6 a week going forward. But I emphasise that's the minimum. And if you've got actual costs that are higher because of heating bills or because you've got more phone bills, which is entirely possible, you can claim for the actual amounts. So keep a record, and it may be worth actually having proper meter readings to do that. Another thing that the Chancellor announced in his budget was the Lost Carryback. Now, this is particularly important for people, small businesses who may have suffered a loss as a result of the pandemic. A loss in normal circumstances is carried forward and reduces your tax in future years. You've always been able to carry it back to the previous year. What the Chancellor said is you can now carry it back 3 years as a special measure. It's actually the same as we had in the financial crisis 12 years or so ago. So what you can do is your loss can be carried back, and it can result in a repayment of income tax you paid 1, 2, 3 years ago. It's worth doing the numbers though, because you can't partially claim, and it means that you may waste your allowances for a year. So do the numbers and work out whether it's worth it or not. And then I just thought we ought to mention again, because of COVID, time to pay. People are going to be in many cases suffering hardship. They're going to have lost income, and they've still got tax bills to pay. Well, time to pay has always been there, so it's important to know that you can ask the revenue for time to pay, but they are going to be particularly helpful at the moment in their time to pay arrangements due to COVID, and in particular for things like on-account payments. So if you've got an on-account payment coming up in July, first of all, it may be that that's too high based on last year's figures anyway, but in addition, because of COVID, there might be reasons why you can ask the revenue to defer that payment or reduce it. So those are the things that sort of initially came to mind.
In my working from home allowance this year, I must say it was very quick and easy, online straight away, and you reap the benefit straight away. It's off your payslip, so you get that straight in your pocket. And hopefully some Telegraph elves are going to be dropping in some links to articles that Mike and I have written about these topics sort of as we go through them. But the questions we were asked most about, or the tax I should say that we were asked most about in our questioning, was inheritance tax, overwhelmingly so. Hundreds of questions about inheritance tax. Really important to Telegraph readers. It's 40% levy. It's quite heavy. Lots of people see it as fundamentally unfair, and basically people want to know how to get around it. So we got lots of questions on that, basically saying what are the ways you can mitigate your inheritance tax bill. And now Michael has dropped off my screen for a second. I'm hoping he can rejoin us in a minute. This is the wonders of doing things from home and working on laptops, but maybe I can go through some of the easier ones off the top of my head and wing it for a little bit. But there are lots of ways to get around inheritance tax. It's often called a voluntary tax because there are so many ways you can beat it. One of these is gifting. There are lots of gifting allowances. You get a £3,000 gifting allowance every year. You can use this every year, and you can also roll it onto the next tax year, but only once, which gives you £6,000. You can also do unlimited small gifts of £250 each year, which is also quite valuable. There's also higher gifts as well. You can give higher amounts on special occasions. So, for example, if your children or grandchildren are getting married, the taxman will let you gift even more. Then we also have the 7-year rule, which allows you basically to make the biggest gifts possible, but almost unlimited. What that does is it resets every year your nil rate band, which is your inheritance tax protection, which is £325,000. So basically you make a gift, you survive that gift for 7 years, and then that gift becomes free from inheritance tax. So it's important to say that inheritance tax, more people are going to be paying it. And we know this, we've seen it in the OBR forecasts. When the Chancellor announced in the budget that a lot of allowances were going to be frozen, including inheritance tax, for at least 5 years. And it's going to raise billions. Michael's just popped back onto my screen after leaving.
My apologies. There is a law about this, that if your line's going to go down, which it very occasionally does, it's going to do it right at doing a live web chat.
Well, I was gracefully going through gifting, and I covered off the sort of smaller gift stuff and the 7-year rule. But one thing I think a lot of readers are very interested in is the gifts out of normal expenditure, which HMRC is quite loath to give us guidance on because I think it is so valuable. So we had a question from a reader saying, can I give regularly to my son to reduce inheritance tax? And I thought maybe they would benefit from this normal expenditure rule, but maybe you could talk us through it and how it exactly works and how you can actually make it work for you.
Yeah, so you've covered normal lifetime gifting and the 7-year rule. The gifting out of income, I mean, it's something I've taken advantage of myself, or technically my mother did. It's basically regular gifts. So it's got to be regular, it's got to be out of income rather than capital, and it mustn't reduce your standard of living. So, I mean, in my case, after my father died, my mother was left with quite a good pension and income and had surplus. And so she very kindly agreed to make payments, I think it was £20,000 a year, towards various grandchildren's school fees, not all mine. And she did that for another 5 years before she died. So effectively, we had 5 years. That's 100,000, and inheritance tax rates of 40%. That's £40,000 of saving. Now, a couple of bits of guidance for that. First of all, when it starts, have a letter. Have a letter from the donor saying, it is my intention that these should be regular payments. The reason for that is, if they die, for example, after 1 year, it is still classed as a regular payment. So get a letter. My My mother had a very well drafted letter that someone prepared for her, i.e. me, which I kept safely, but she didn't find it. The other thing is keep records of, in my case, my mother's income and her expenditure, so that when it came, after her death, came to claim this, I actually gave the tax inspector a whole pack of information showing that it was out of her surplus income and not out of capital. And it was agreed very quickly. So those are the key things. Make sure it's regular, it's out of income, and it doesn't reduce your standard of living. Bear in mind that it isn't just regular giving of this nature that you can do. Maintenance is perfectly acceptable. So, for example, paying maintenance and living expenses for your children, paying for your children's education, paying for your mother-in-law's extra assistance and what have you. That is fine. It's out of income, and it will be just regarded as a maintenance over and above any other exemptions you've got. A lot of people forget that one.
Unlimited, there is no real cap.
No, there's no limit on it. As I say, my mother did it for £20,000 a year, but if she'd been extremely wealthy, it could have been a much bigger figure. But that was the figure that she felt comfortable with and satisfied the tax rules.
So some people asking about using trusts in a limited company. Also, people asking about gifting homes to avoid inheritance tax. Well, this is sort of what Mike was just talking about, this gift with reservation of benefit rules, as they're known. I've written about these a number of times. I've obtained figures from HMRC, and hundreds of millions are lost to inheritance tax every year by people who mistakenly believe they can gift the family home down the line and continue to live in it with their children. You have to continue to pay the market rate of rent if you want to do that. Otherwise, it will fall foul of the gift of reservation rules and you'll be caught out. And Mike's back with it after a second.
Apologies again. I don't know why I've done that twice, but maybe I had it go once when the farmer next door went through the phone line with his harvester. But anyway, yeah. So the reservation of benefit rule, you've got to be careful of. Trust can be useful if you have got, if you want to make a gift into trust and you know you don't need the money for yourself. So let's say we're hoping to benefit our children. You could give up to your nil rate plan £325,000 each. And after 7 years, that simply drops away under the 7-year rule. So, you could give, if you felt sufficiently flush, you could put between the two of you £650,000 into a trust. As long as you live 7 years, that is money that's out of your estate. And the advantage, I suppose, of a direct gift is that you've still got some control on it. I mean, there's nothing to stop you being the trustees. There's nothing to stop you effectively exercising a control over when money is paid out. So if you're putting it in trust for your children and in 7 years' time, you're not, or at any time, you're not really sure about their financial strength, if you like, or they made a bad marriage or something like that, then you've still got some control over it. There are other much more complicated trust arrangements, discounted gift schemes and things like that. They are really only to be undertaken with advice, in my view. I wouldn't do it on your own. But there are plenty of companies that will produce these things and they'll do all the paperwork for you. Yeah. So, and I have written before about discounted trust schemes.
And what about paying school fees? That can be quite a good way. You can just put your nil rate band into a trust, 325 grand into a trust, and then that can be used to pay for school fees. You've reduced your estate and it's completely tax free and there are no extra charges. Is that an oversimplification?
I mean, the best way to do that is if you've got grandparents that like to put money into a trust to support the children. But essentially, yes, you can use a trust as a way of putting money aside. I said in one of my articles that don't ignore what are called bear trusts. A bear trust is simply a nominee holding. So if you've got someone, you ask someone to be the legal owner of an asset, but beneficially it's for your children, and these can be minor children. From the day you're born, you have an annual capital gains allowance. So you can utilize that. You have a personal allowance effectively. The only problem arises if income arises from the parent when they're still minors, then that's added to the parent's income. But sometimes a bear trust can be useful. So it's not just, if you like, a formal trust. Bear trusts have a part to play.
tax are going to become more important because we're all going to be paying more.
Well, sadly, the Chancellor has set the threshold at £325,000. If it had risen in line with inflation, it'd be near enough 500,000 today. And it's unfortunate that the asset values rise with general inflation and what have you. The inheritance tax threshold stays frozen as it's been announced. Then it will inevitably draw more and more people into the inheritance tax net. In one of my articles, I quoted Kenneth Clark in 1996, I think it was, and he said, "Inheritance tax is a penalty on thrift, independence and enterprise, largely paid by people of modest means who don't make careful plans to avoid it." And that was a long time ago, but it holds true today. I mean, inheritance tax is an inherently unfair tax. It doesn't catch you if you're up to the £650,000, or could be up to £1 million with the residence nil rate band added in. If you're worth £50 million, you can afford to make lifetime gifts and still have plenty to keep you comfortable. But most of us in the middle will potentially suffer inheritance tax, if not the least because of rising house prices and what have you. And unfortunately, there are things you can do, but it's easier when you're very rich to do things. That's the unfairness of it in a way.
Yeah, and also, so the OBR stats show that more people are going to pay this year because of the coronavirus death toll. I think the numbers are going to hit somewhere around 30,000 people going to pay in the year, and the tax take that the government receives is going to hit a record high of about £6 billion. So hopefully people can use some of those exemptions and avoid, as I say, what is sometimes called a voluntary tax. But
there are ways, of course, the government will also make money from COVID, and that is people that are dying won't be collecting their state pension for so long. There is actually quite a big number. I can't forget what it is. There's a big number associated with that. And of course, people will die. Their houses will come up for sale. Someone will buy them. They'll collect, in all probability, additional stamp duty as well. But I'm sure the government are factoring all that in somewhere in their figures.
Well, you'd hope so. I think get what you can while you can is my outlook.
We had another thing, which is pension flexibility, because from an inheritance tax point of view, the additional pension flexibility we've got makes it actually attractive, other things being equal, to spend your own money rather than pension fund money, because on death, a pension fund has a much more attractive, it's not taxed in the same way as your estate from an inheritance tax point of view, and it can continue and effectively get taken over by your kids. I mean, they pay income tax when the money comes out, but don't forget pensions.
Yeah, keep your pension for as long as you possibly can is normally the advice. And there are other things you can do as well, of course, like insure. You can take out an insurance policy that is paid into trust, like Mike was talking about earlier. But we've got lots of articles about this, so go and have a look at these articles. There are various ways of getting around inheritance tax. But maybe we should move on to property taxes. I could see in the chat bar that some people were talking about capital gains tax protections as well. But we've had a couple of questions. This one looks like an accidental landlord to me, and we know that landlords are beginning taxed more heavily over recent years. It seems that the government wants to dissuade people from owning second properties. As we know, there is an ongoing housing crisis. But this person says, my partner and I have our own properties. We plan to move in together at some point in the future, eventually selling my property. What is the most tax efficient way of doing this? Basically, how can I avoid becoming an accidental landlord and getting hit with a big tax bill, I think is the key question.
Well, first point to make is that up until the time that they move in together, they've each of them got a home. It's their principal private residence, and that will be exempt from capital gains tax. Once they move in together, one of two things happen. Either they put the home on the market and sell it, or they decide to keep the property, let it out as a useful source of rental income. There is, as a married couple or couple in a civil partnership, you're only allowed one principal private residence. It's just one of the main rules. However, there is a 9-month overlap. So in effect, you can effectively double up for a 9-month period, because the final period of ownership is always deemed to be qualifying for private residence relief. So, for example, in the couple that we've got here, they move in together. Let's say they move into the guy's house, and the lady has a house which is then, it's empty. If it's empty for 9 months, that's not a problem. Even if it's empty for a couple of years, it's unlikely to be a problem, because the way capital gains works is done on a time apportioned basis. So if you think about it, if you've lived in a house for 9 years and then it's empty for a year, well, the last 9 months is protected anyway under the rules. So you've got 3 months there. 3 months out of 10 years, you're almost certainly going to be within your annual capital gains exemption. So don't worry about it. I mean, I have been in this position. My daughter, when she went to university, she had with the help of her parents, who put up a deposit and guaranteed the mortgage, she became a student landlord. And she then continued, after her 3 years at Cardiff University, she continued to let the property out for several more years. And with all the various reliefs going, when she eventually sold it, there was actually no capital gains tax because of various principal private residence reliefs, some of which have been trimmed. The letting relief has been trimmed. But of course, if you're actually living in the house, letting relief still applies, and that's pretty generous, up to £40,000 worth of gains relief. The other thing to bear in mind, I guess, about property, if you do let it out, you're then going to get rental income, rental profits. You need to take care. For example, suppose one of the houses had a mortgage and one didn't, then it may pay you to have the house that has a mortgage on it, because although higher rate relief has gone, you've effectively still got a basic rate relief on the let property. And it also makes sense, if you're going to have rental income, for the property to be in the name of the spouse on the lowest income. And of course, that you can change once you're married or in a civil partnership. You can transfer properties tax-free between each other. Be careful if there's a mortgage on it, because if the mortgage changes, that can trigger stamp duty. But you should aim to, as in this couple here, if it's being let out, try and get the income, if possible, with the benefit of the basic rate interest relief, and again, in the hands of the person with the lowest tax rate.
Yeah, and you mentioned the lettings relief has obviously shrunk, well, it halved, didn't it, from 18 months to 9 months. Lots of other...
Well, that's not letting, that's the overlap, the 9-month overlap. It used to be 3 years. It was 3 years until, dare I say, we had the parliamentary expenses scandal, because it was discovered that a lot of MPs were taking advantage of the 3-year rule. It worked very well for them. And then as a comeback, it first dropped to 18 months and then subsequently to 9 months. Letting relief is a different form of relief. So, for example, someone who's a student landlord living in the property as their principal residence, but letting some of the rooms out to friends and they all live as a family together, that's where you can still get letting relief. And you can also get lodger relief. Now, lodger relief you won't find in the statute book anywhere, but you can effectively get relief for one person living with you, effectively as a member of the family, as a lodger. And that is a frequently forgotten and very useful exemption.
We had another question from the landlord. It seems like they were asking about capital allowances potentially. They were basically saying, I wish to pay less tax next month because I've already paid a lot to HMRC. Should I do some maintenance on my rental property to eliminate my tax bill? Now, is that something you can do?
Well, yes. I've been in this position myself because we've had a let property. We've actually just sold it last month. But for example, we put in a boiler, replaced the boiler. The boiler was pretty well shot after 10 years, and we replaced the boiler, and it now works relief instead of the 10% allowance. It's now worked on a replacement basis. So the cost of that new boiler was immediately allowable. And you know, there are some expenses that you can, repairs in the main are the things that you've got some discretion over when you spend it. In general, capital equipment, suppose you put an extension, that's capital, that's not going to be expenditure. It'll be taken into account when you sell and you calculate your capital gains tax bill. But under the rules that exist at the moment, the replacement of an item that's sort of a similar item, but the other one's worn out, that is fully allowable. So you get the benefit of that. Yeah, you still there?
Chat box with someone saying, does this all pertain to England and Wales and not Scotland? Because there obviously are different tax rules for different areas of the UK, and we probably have a habit of talking mainly about England and Wales, which I think, you know, is probably the way we do approach it, being the Telegraph. But it does most of this stuff pertain to England and Wales, Mike?
Well, I'm going to admit that although I'm 1/8 Scottish, I don't know an awful lot about the special Scottish tax rules. As far as I know, what we've just been discussing applies to Scotland as well, but I can't guarantee that.
Something esoteric is probably worth researching specifically if there was a specific tip or trick you were trying to use, and see if it applies in each region. Is probably the way to go about it.
I mean, if anybody wants to ask about a special position in Scotland, you know, we can always, when I do articles, you can put comments at the bottom, and if you put a comment, I will always try and respond to comments where I think I can say something that's useful to the person who's raised the question. So do it that way.
Yeah, definitely. Always get in touch. Write to the journalist, write to Mike. We will endeavour to respond. Some questions from some higher earners. One chap asked, what are your recommended strategies for those earning over £100,000 to be tax efficient? And another similar earner saying that they earn more than £100,000. It's all right for some, I suppose, but they are saying, how can they maximize their take-home pay other than contributing more to their pension? So I suppose pension is the first port of call. Is there any other ways of maximizing your take-home pay, and maybe talk a little bit about, you know, how valuable that pension relief is, and maybe some of that carryback, because I noticed some people were also talking about carryback of previously unused allowances as well.
Yes, well, first of all, it's probably not helpful to say for income tax, this is the wrong time of year to be talking about how I save income tax, because income tax, you generally accumulate your income throughout the year. So the best time to be planning income tax is actually at the start of the tax year, not the end of the tax year. But having said that, I mean, capital gains is different. Capital gains is a point in time. You sell shares or you sell property at a point in time. So planning for capital gains is perfectly sensible at the end of the tax year, because you've got a better idea of what your position is. Pensions, yes. So for someone in the band between 100,000 and 125,000 for this year, are going to be faced with effectively a 60% tax rate, because your personal allowance start to be phased out on a 2-for-1 basis, so 1-for-2 basis. So between 100 and 125,000, your marginal rate is 60%. So that is when pension contributions are particularly advantageous. Subject, of course, to the limiting factors, and for most of us, the limiting factor is £40,000. So up to £40,000, unless you're on a very high income above 240,000 odd, then that is the sensible thing to do. And it is all relievable at your top marginal rate. So if you're in the band, suppose your income's 120,000, paying £20,000 in allowable into your pension fund, you're going to save at 60% on that. The other thing I should mention, I suppose, is gift aid, because if you make a gift aid payment, that is relieved at that time. So suppose you put £80 into a pension fund, into a charity. The charity gets £20 back, so they've got £100. You've paid 80. You can get another £40 worth of relief, making up a total of £60 worth of relief. So when you're in that marginal band, if you're minded to help charity, that's the time to do it. But you may as well get 60% rate rather than perhaps 40% that you might otherwise be paying. The other thing you might be able to do is if you have an employer who's thinking of giving you a bonus, you might make sure that they pay the bonus in a year when it doesn't take you into this 60% band. Sometimes you have some discretion as to when your bonus is taken. And the same thing might apply to share awards, depending upon the type of share scheme. When shares vest under certain share schemes, there is effectively an income tax charge at that stage. And if it's a listed security, for example, it will be dealt with under PAYE. So in those circumstances, there may be some alternatives as to when your shares actually vest, but that depends on the scheme arrangements. Some are automatic after 3 years, so it depends what your scheme arrangements are.
Inheritance tax, obviously giving to charity has inheritance tax benefits as well, and if you gift a tenth of your estate, it will reduce the actual rate that you pay of inheritance tax.
Yes, when this was announced, I think it was George Osborne announced this, I thought this was just a bit of a gimmick, I have to say. And I forget the numbers, there are quite a lot of estates that have been taking advantage of this. So if you want to give to charity, I mean, obviously the full amount that you give to charity in any event comes off your estate, so that's completely taken out. If you give £100,000 to charity on your death, that is not part of your estate anymore. But as you say, if you give 10%, then you effectively take your tax rate down to 36%. So rather than the 40% that normally applies. So take advantage of it if you can. And whether you think it's just a gimmick or not, that's a personal point of view.
Less, but you'll be giving to charity at the same time, and the tax man will be taking less. I think that's the idea behind it, isn't it?
Yes, I mean, giving to charity, yes, it says it doesn't make you better off, but you get that nice warm feeling that you're benefiting the Salvation Army or whatever it is that you choose to support.
And we had another question, someone basically saying, HMRC keeps tinkering with my PAYE, so with my payslip, as my salary has risen. Do they get it wrong, and should I check their calculations?
My view on tax coding is that it's a three-way process. There are three parties involved. HMRC is one of the parties, but they're not the only party. Another party is your employer, and another party is you. And I think there's a joint responsibility for all three of you to try and get your coding right. HMRC only know what they've been told, and they're going to get told that either by you or your employer, depending upon the circumstances. So make life easy for HMRC by informing them whatever company car you've got, or if you've got suppose your firm employer starts to pay private medical cover, for example, you need to tell them that. So then there's a better chance of getting it right. But as an overall comment, when PAYE was introduced in the 40s, I think it was, life was easier. People generally had one source of income and it worked fine. Life's a lot more complicated now, and the PAYE system is creaking. And in most cases now, the PAYE system is, and the coding system is only going to give an approximation of how much tax you owe. At the end of the year, there will be a reconciliation carried out, and that applies whether or not you're in self-assessment. With self-assessment, it's effectively an automatic process when you file your return. But even if you're not in self-assessment, a reconciliation process takes place. And you may remember, it must be 8 or 10 years ago, there was a big furore when we discovered there was about 4 million people who had paid the wrong amount of tax because the revenue got the coding wrong. And one of the things they got wrong, and it can still happen, is the people who are pensioners. And if you get your state pension, people often think your state pension is tax-free. It's not. It's taxable. It's just that it isn't normally taxed because it is generally the source against which your personal allowances are first set. But pension income is taxable. I know because I receive a state pension, so I see how it takes part. And I have 3 coding notices that come out to me from various pensions and what have you, and they always get it wrong. So there's always a catch up at the end. And I try hard to explain to the revenue what the code should be, and sometimes they get it right, but very often they don't.
To touch on council tax. Now, council tax is up this year again. Some places 5% rise. Some people are going to be paying more than £4,000. A lot of people are going to be paying about £2,000 for the first time. It's actually quite a lot of money compared to other levies as well. But there are ways you can cut your council tax bill that maybe people aren't aware of? And maybe we could briefly go through some of those.
Yeah. Okay. Well, I have written about this, and I don't think it's appeared online yet. I'm hoping it will appear online this week, and it may even appear in the Saturday Money section in the paper, because it seems to me that council tax. Well, it hit the news, of course. It hit the news, I think, because we've seen the increases. And I think it was one of your articles which said that on a typical Band D property, council tax is going to rise by, was it 4.4%? And that's a lot more than inflation. So I think, council tax, it's a big tax. Council tax raises for the Treasury as much as inheritance tax, capital gains tax, fuel duty and alcohol duty combined. So it's a very large item of collection for the revenue and expenditure for us who pay council tax. There's essentially three things you should keep in mind. First of all, can you claim a discount for your council tax? Are you in the wrong council tax band? And is there anything that you can claim by virtue of COVID relief? So starting with those, claiming a discount, if you live alone, you get a 25% discount. Students are not only not liable for council tax, so that a student living in a property doesn't trigger a liability, nor are they counted towards the single person discount. So if you are a parent with a daughter who's a student, and they're only the two of you living in the house, then there's only one person and you get your 25% discount. But you have to make the council aware of this in order to claim it, and a lot of people don't do this. Carers and those with severe mental impairments aren't included in the assessment. If you have a low income and your partner have savings investments less than £16,000, you can get a discount. If you receive guaranteed pension credit, you may be fully exempt. Homes that have been adapted or are larger to accommodate someone with a disability, that's another reason. If your home is empty because you've moved into hospital, or perhaps you've moved into a care home, or you've gone to live with a friend or relative who's caring for you, then you can get the discount. There's no council tax due at all if the property is empty, because you say the owner has died. You don't pay council tax until 9 years after probate is granted. And if the property is empty, to allow major renovations to make it habitable. So if you've got a pretty rundown property and it's not habitable, there was a tax case on this quite recently. I think the judge said, well, it might have been habitable for a passing tramp, but not for anybody else. So that was a useful comment to put away. Holiday lets, so if it's a major renovation, to make it habitable, that gets a discount. Changing your tax band. Oh, by the way, on holiday lets, you'll have seen, in fact, I don't know if it was your article, Harry, talked about a clampdown on holiday lets in the budget, furnished holiday lets. Furnished holiday lets, a qualifying furnished holiday let doesn't pay council tax. You can claim business rates instead. And because of the small business rates exemption, around 96% of furnished holiday lets don't pay council tax, and they don't pay business rates either. So that's very useful. The so-called clampdown that I think you wrote about, to my mind, it's just saying we're going to apply the rules that are already there. So I wouldn't call it a clampdown. I'd just say, can you please follow the rules? We're not trying to save tax by cheating here. We're trying to do it following the rules. So I think that is the way to look at it. And quite frankly, I was expecting the government to go further and stop people claiming business rates and the business rates discount altogether. So be grateful for what you're getting. Changing the tax band, that is not without its risks. You need to be very careful, because if you say I'm applied to the council and the valuation department for a change in your band, yes, you can do that, but it's a two-way traffic, because they may decide that you should be banded in a higher band. So it's going to cost you money, and it might have another adverse consequence. Is that you live in a street of similar houses, they can then come along and say, well, maybe we've got all these wrong as well. So they might actually increase the banding. Bear in mind that these bands are all based on 1991 valuations, or 1993 for Wales, strangely, and they weren't done in a very formal way. In fact, the way these valuations were done, there would be two people in a car going along the road. very slowly, and the person other than the driver would simply write down what the valuations were without even stopping the car. And they had the glorious title of second gear valuations. So you've probably heard the expression second gear valuations. They're not very accurate and they're often wrong. But if you're going to appeal, go through a process. My suggestion is you first check with your neighbours. You don't actually have to ask them what band they're in, because we're going to put up a link when the article goes live for the valuation office agency. And if you put in your postcode and check the address, you can find out without having to ask your neighbours. If you bought the house after 1991, start with that number. For older purchases, go into Zoopla or one of the other websites and search for what the Rightmove's the other one, isn't it? Search for what your property is worth now, and then you work back to what it was in 1991. That's using something like the Nationwide or the Land Agency website. That'll tell you how you can work back to what the likely band would be then. Take into account any improvements like a loft conversion or a conservatory, because even though you've put it on since 1991, that will still be taken into account in the valuation. You'll be deemed to have had it in 1991. So, be very careful about improvements to the property. And only when you've done that, if you're confident you're in the wrong band, then you can apply. But do your homework first. And then finally, I thought I'd mention COVID relief, because if people are suffering financial hardship, as many are, council tax is one of the things you can apply to your council and ask for relief from some or all of your council tax. And the government announced very recently that in fact, I think it was at the budget day, that they're going to make additional assistance available to councils for the so-called hardship fund. So if you're in one of those positions where you really have struggling to pay council tax because of COVID, then you can appeal to the council for relief from council tax. It's on a discretionary basis. There's no rules that I can see specifically, so they'll see how to allocate their own hardship funds on a council by council basis.
So proceed with caution. You don't want your neighbours' bills going up as well as your own. I think that's all we've got time for, unfortunately. We're actually over time. But thanks, Mike, for speaking to me, and thank you to the audience for watching.
Just could I say, first of all, thank you all of you for joining today. Thank anybody who puts their comments online. So I'll reiterate, I do look at the comments that come up on articles. I want to write about things that you want to know about. This isn't an academic exercise. This is an exercise in helping you save tax. So you need to feed me the things that you're concerned about. And I will endeavour, in the answers to those questions, endeavour to find the things that there's a common theme and try and give some helpful answers. So thank you for all of those who have participated in that.
Okay, yeah, thanks, Mike, absolutely. And that is everything from us. So everyone, please enjoy your evenings, and we'll see you again soon.